It was a really tough problem to solve at the very beginning because similar to the chicken and the egg problem of having to have equity to raise debt or debt to raise equity, you can't really write an underwriting model unless you have performance data, but you can't have performance data unless you give out loans, and it's a little bit scary to give out loans without any kind of underwriting model.
Hi, I'm Chris Nedza, lead entrepreneur in residence of the Advanced Technology Development Center at Georgia Tech. We're the state of Georgia's technology incubator. Welcome to Season 1 of the ATDC podcast, Executive Bytes. We focus on the startup founders in our portfolio, what sparked them to launch their companies, the market problem they've solved, and even how they overcame the thoughts of quitting when times get rough. Enjoy.
Super duper excited to have Jack Markwalter with Viva Finance with us today. But before we jump into Jack's story, we have two amazing CEOs that are joining us. They're also ATDC signature CEOs. Sander Biehn from Ready for Social. He's going to be on a podcast. We're going to dive into his company. But I do want you to know it's an enterprise level social media management company. So enterprise level. And we'll dig into his company later. And Scott Ryan with Montra Technologies. Scott's been around ATDC for, quite a while. And you've had 2 or 3 companies that have launched in and out of this place, right? So so we're gonna dig into him, but let's get started with Jack, and I'm gonna kick it off with just a question, and we'll start rolling with the with the fun. Surprise, small fact. I heard, is it true that you were selected by Forbes 30 Under 30 for 2024 for social impact? Is that true?
Yeah, that is true.
Huh? All right,
Congratulations.
Yeah.
Thank you.
Yeah, it's awesome.
Really surreal experience. So really much more of a tribute to everything that our teams put together, but it was really cool to get that kind of recognition for what we've done.
And how many billions of likes in Facebook, or you probably don't even use Facebook, you're so young. But tell me, let's jump into with Viva Finance. Give us how'd you get the idea with it? Because I think you were at Notre Dame as a student, but take it from your idea and what happened.
Yeah, so the mission at Viva Finance is to build an inclusive financial system, and really it was inspired by my time at Notre Dame. I got involved with a nonprofit there where we were trying to offer loans to people in the South Bend, Indiana community. I went to Notre Dame. We were trying to offer loans to people in the South Bend, Indiana community who had to go to payday lenders and title pawn lenders in order to get access to credit. Those lenders can charge hundreds of % interest annually, and kind of working with people on a one-to-one basis saw how big of an impact lack of access to credit has in people's lives. So I got involved with that in school. After graduating from school, I went and worked down in Tampa, Florida for an investment fund for a couple of years, and we were investing in consumer finance businesses. During my time there, I saw companies that were utilizing kind of payroll as a means for repayment for different items, things like student loan repayment. And after my time with Jiffy, that was a nonprofit that I was involved with at Notre Dame, I thought that could be a great payment mechanism for people to repay personal loans. And using that, you could actually try to offer access to affordable credit using metrics outside of just FICO score and potentially looking at employment stability instead. So that really kind of inspired our idea, and I think a lot of the technology shift within payroll systems made it a lot easier to start that type of business as well. So we're a little bit lucky timing-wise.
So let me make sure I heard you right. So basically, you're using payroll to help people get lending, so their work history is what's driving that versus their credit score.
Exactly. So you've got below a 670 FICO score in the U.S., on average, you're going to pay somewhere between 50 and 110% interest annually. So there's really a huge cost to that, and by underwriting on something other than FICO score, we can allow people who might previously would have to get those interest rates to be able to use their employment stability to get access to lower rates.
So tell us a little bit about how do you go from, you had this idea about trying to help people who are kind of in underserved communities of people getting access to inexpensive capital, I guess, or inexpensive loans. How do you go from just the idea to actually building a company that does that?
So from loan sharking to a company, correct?
Yeah.
You are not loan sharks, you're helping those. Okay.
Exactly. So my brother and I had the idea back in December of 2018. We were actually together for Christmas, talking about different business ideas, and ended up coming up with the idea for Viva Finance. And After our conversation, we decided to start working nights and weekends to put together a business plan. And really, after doing that for 4 months, we got to a point that either we had to kind of stop working on this and just kind of get back to our day-to-day lives, or really try to pursue the business. And so ended up quitting our jobs in April of 2019, raised some capital from friends and family, and then to get started, we decided the best way to do it would be to partner with a company in order to offer loans to their employees. We thought from a distribution perspective that could make a lot of sense just to get us off the ground, because we needed some form of legitimacy. And it took us really 8 months to raise the money, build the platform from a technological perspective, and convince a company to trust a 24 and a 22-year-old to let them lend to their employees. It's not a concept that people are used to on a day-to-day basis, but thankfully Clayton County Public Schools was supportive of us and ended up launching with them in January of 2020.
Clayton County is in Georgia?
Yeah, in Georgia, just 30 minutes south of here.
Okay.
That's really great. I mean, I would like to hear more about like what that 8 months was like, especially working with your brother probably for the first time in a business setting, and what was that dynamic like? And also, as you guys were, looking at probably a burn and you were out there raising money, like tell me more about that.
Yeah, it was definitely a hard period, and probably the hardest period at Viva overall, where just psychologically going from having a good finance job to then seeing just money leaving your savings account as you're trying to get something going. I moved back in with my parents at that point just to try to save some money. I was in Tampa, moved back to Atlanta at the time. And just getting started, you have a lot of really big framing conversations where you're trying to determine really direction of a business that you don't even know what it's going to look like yet. And so a lot of times those philosophical conversations, especially when you're having those conversations with a brother or a family member, you're not scared to disagree. And those can be some pretty big things to do.
Was he under the same roof with you at the time? Like, did he move back home too?
He did not, thankfully. Okay. I think that would have almost been too much Viva all at once. We were
Too much family.
Yeah. We were definitely, there were times where we would have family dinners during the week, and Viva was a key talking point. I think we might have had too much conversation at times, but he was living with some friends at the time, and so had a little bit of space from each other. But during the day, he would just come over to our parents' house. We would go to the attic and work on Viva.
Cool.
Talk to us a little bit about, for people that don't know, I guess tech finance companies, fintech tech companies have two ways of raising money. You got to raise money, and you need to keep them separate, regardless of what other entrepreneurs think. And so, which money did you raise first? How do you go about like playing those two off of each other and getting?
What are the two
company
types
funded?
that you're referring to?
Well, I'll let him talk because I don't know. Like,
Yeah.
there's the money that you're going to lend out, and then there's the money that you use to operate the business.
Yeah, exactly. And that's especially for a company where it's like your inventory, what you're selling is money. It's really expensive to finance that just with equity capital. And so, Scott, as you're alluding to, a lot of fintech companies will raise debt or find some other financing to fund your loans. And so when we were first getting started, it was a little bit of a chicken and the egg problem, where it was hard to raise equity money because every equity investor wanted to know, well, how are you going to fund your loans? And am I funding your loans right now? And if so, then how are you going to fund your burn and OPEX? But then on the debt side of things, people didn't want to give you money just because you didn't really have a business yet, and you couldn't really have a business.
And you're a wise 24-year-old, right?
Yeah, wise 24-year-old, many years of experience to know how people typically do this. But we ended up raising equity capital from a small group of investors, really to try to get to the point of showing that we had proof of the concept and that we could actually give out loans. And so that was kind of the first milestone that we targeted. And we had a couple of key investors in that first round, that kind of friends and family round, who ended up being willing to put personal guarantees on a debt facility that we raised with First Horizon to fund our first kind of couple $100,000 of loans.
Yeah.
And so ended up using that good enough proof of concept to raise from a private debt fund. And that private debt fund we still work with today and have a $65 million facility with them.
Wow.
I should have asked this question earlier, like what earns you the right to be interviewed today in this podcast? Can you give me some of those metrics, like share Like, where are you guys now? I mean, I know it's awesome, but I want our audience to know.
Yeah, it's crazy to think about today that I've been doing this for over 5 years, and officially started the company in April of 2019. And since then, since launching the platform, we've processed over 200,000 loan applications. We've got 40,000 customers today who use our platform. And then we're operating in 41 states, and we actually recently started generating cash as a business as well. So we're cash flow positive too. So really excited by some of the traction and growth we've seen in the last few years.
Congrats.
Thank you.
on
Yes,
that.
yeah. Round in the bend, as they say, right?
Yeah, exactly.
So when you guys were first getting started on lending, did you do you have your own algorithms that you're working with, and then how do you decide to get I guess success quickly back to prove to your investors to give you more money to lend?
Yeah, it was a really tough problem to solve at the very beginning because similar to the chicken and the egg problem of having to have equity to raise debt or debt to raise equity, you can't really write an underwriting model unless you have performance data, but you can't have performance data unless you give out loans, and it's a little bit scary to give out loans without any kind of underwriting model. Mm-hmm. So what we did in my previous job, I did a lot of underwriting model creation for some of our portfolio companies. So I had a little bit of experience in building these types of models, and we wanted to partner with companies both for distribution, like I mentioned earlier, but also we would ask these companies that we were pitching to provide us with employment information. And so we ended up in historical kind of turnover history for their employees. So we ended up getting a pretty solid database in the education system of a few 100,000 data points of how long people were on their jobs within certain positions over a period of kind of 10 plus years. And ended up using that to create the first version of our credit model. And today it's much different. We use machine learning and in our underwriting, but we couldn't have gotten there without giving out tens of thousands of loans with this rules-based model.
Sure. What's the typical term on the loans?
2 years.
Okay. And so you were able within a couple of years, or even do payments start immediately? You're able to show to your investors pretty quick traction on that your algorithm's working, or whatever your underwriting algorithm's working?
Yeah, exactly. So we'll look at what we call delinquency curves, which is really how fast and how many people as a percentage are going delinquent within our portfolio. And so you can kind of track those curves early on to say, hey, the loans that we gave in 2020 within 6 months of originating those loans are performing much better, or were performing much better than the 2021 loans, or vice versa.
So let's go back to the first loan. That's what I'm really interested in, and that is raising that money. So how'd you find your way here to ATDC? And if, I'm assuming you've done more raising since you've been here. How has that been different, and how has it helped your? I'm not trying to
I mean, it's a shameless
shameless pitch, but I'm actually curious to know like how those two processes looked, and how hard it was the first time, and what sort of things you learned there.
Yeah, no, it's a great question. We joined ATDC in May of 2019, so just a month after starting our company, and my brother and I, when we were getting started, we just reached out to anybody who we knew, either from school, sports, growing up, or parents' friends, or friends' parents, whoever we could talk to who had started companies before, to get any kind of advice from them. And one company who used to be here at ATDC, Press Sports, my brother grew up playing baseball with Conrad, who was one of the co-founders.
Oh, wow.
And he was at ATDC, and so when they had started Press Sports a little bit before we started Viva, and so we went and visited them at ATDC, and they had some office space here, and he basically said that when we were getting started, we needed to join ATDC to just get into the networks, get some advice as we were getting going, and talk to other companies. And so ended up joining in May. There wasn't any office space available at the time, though, so continued working out of our parents' attic for another couple months.
That was 2019. 2020, things changed a little bit with office space availability.
Yeah.
Lots of it.
Then there was availability, but
no one was
not
going
as much
there.
demand.
Yeah.
I didn't know that. I have to give Conrad a pat on the shoulder. He's a good guy, for sure.
Yeah, he was so helpful early on for us.
Touched a lot of people here at ATDC.
Yeah, amazing guy.
Yeah.
Hey, have you seen? I know you started it because you felt a need to help people. Do you have any stories where it's impacted somebody's life that you know, or and if not, it's okay. But I just was curious if you had any of that human side.
Yeah, it's I got to see some of the direct human side when I was working at the nonprofit back at Notre Dame, and so that was really where I got the highest touch. At Viva, I think really what we look to is our customer reviews. And so one of the things we're very proud of, we've got just about a 5-star average for our customer reviews on Google. And I've heard from some of our employees that they've had conversations with people in customer service who were literally in tears because they had the opportunity to basically pay back a payday loan that they were paying a couple 100% interest on. And it's just life-changing for them. But the coolest moment for me at Viva, I think it's still the coolest moment, I was down in Tampa speaking at an accelerator, Tampa, Florida. This was in 2022. And after the event, someone came up to me and they said, hey, I just wanted to thank you. My sister works at Tampa General Hospital, and she actually took out a loan with you guys a couple months ago. She called me and had no idea what to do. Her kid had broken his arm. He had to go to the hospital, emergency room, and she had medical bills that she didn't know how she was going to pay, and she called me asking for advice. And I Googled and I found you guys and told her to use Viva. She ended up getting a loan from you guys, and she's in a much better place now. And so I wanted to let you know that you guys really helped her out. And that was the coolest thing to me, was just being kind of out in the wild and running into somebody who at least knew someone who was touched by us.
Yeah, that's awesome. That's amazing. So your business hasn't pivoted at all?
I'd say we've pivoted not from a mission perspective or not from the need that we're serving, but how we've done things. And so I'd say our biggest pivot early on when we were first starting the company, we thought we were primarily going to be a benefit for employers. And we ended up, shortly after that partnership with Clayton County Public Schools, we started getting referrals from some of our early customers to people who worked at Atlanta Public Schools and some of the other public schools in the area. And we ended up kind of changing our payments infrastructure to actually work on a direct-to-consumer basis rather than working through companies, just to try to meet some of that demand and grow quicker. But that's probably the biggest pivot we've had.
Okay, interesting.
So what percentage do you still work with companies in their HR departments or as part of their benefits package, or is it all direct to consumer now?
Yeah, we have a few legacy partnerships from some of those early days. So we work with Rollins Pest Control, Children's Healthcare of Atlanta, Clayton County Public Schools. But most of what we do today, it's like 95% of our loan originations come from people who hear about us outside of those partnerships.
So, just looking at a go-to-market and awareness and all that, maybe it's through Google searches or whatever. I mean, I've had the experience, lots of other people had, what part of town you're in when you see the tidal pond places on the side of the road. And that's how they advertise themselves, I guess, is they've got a big sign, in neighborhoods for the people that need those kinds of loans. How do you reach those people? How do you make sure they're aware that there's a better option than those types of loans?
Yeah, when we first started, we actually did it by trying to get out in the community. And so one thing that's kind of key to our founding story is we used to hand out donuts. And so we started off wanting to work with people who worked in education, government, and healthcare primarily. And so when Grady Hospital would do their morning shifts at about 6 in the morning, my brother and I, before work, and some of our other employees as well, we'd run to the Dunkin' Donuts by our office and then drive to where they were conducting shift changes. We'd set up a table by the parking lot and basically hand out flyers for Viva. And so early on, it was all about just doing whatever we could to get in front of our customers. And at the time, we saw more than one person apply versus the number of donuts that we handed out, so I thought it was a pretty good,
good ROI.
But today we work with a bunch of channel partners, and so 1/3 of our loans come to us from word of mouth referrals. So that's always going to continue to drive further customer growth. But we work with channel partners who work with employers in another manner. And so we've got a lot of newsletters that we'll sponsor. We'll work with some of these outsourced benefits companies to raise awareness for a bunch of employers, and talking to payroll systems as well as a means of getting the word out.
I would also guess that, and this is very different than my business and probably Scott's too, is that there is an interest in the public space around what you're doing, because it's truly a benefit to people who are forced to pay that outrageous interest. Have there been any public-private, like from your point of view, talking to public groups about this, either in Atlanta, Georgia, or beyond?
We haven't done as much on kind of any interest groups, or we did have a couple of kind of senator offices speak with us. They were doing initiatives about trying to kind of expand the credit box, basically, like expand access to credit, and kind of asked us more informationally. But I definitely agree with you. I think some of those partnerships are there. For whatever reason, we haven't had so much traction.
Yeah. Interesting.
So I know, like anybody listening would go, "Oh wow, he's made it."
Yeah.
It's always the question. Do you think you've made it yet?
No, not
All right.
yet.
Next question.
Will you come back once you have?
But here's another question. In related to it, how do you get your advice? Who's giving you wise counsel? Do you lean into your board? Where are you getting your advice? Because I know you've got a lot of things to navigate as well as you're doing, which is amazing. I know there's a lot of questions that come up. Where do you get the advice?
Yeah, I'd say from other entrepreneurs has really been the best source for us. And so whether people were introduced to us through investors, ATDC, people who have started other, especially fintech lending businesses because it's so unique, have been great for us. And so Rob Frohwein, who's one of the founders at Cabbage, is a formal advisor for Viva, and he's probably one of the first people we go to if an issue comes up. Jeff Bogan, who's CFO of Upgrade, he's from Atlanta, Georgia. He was one of the early Lending Club employees, and so he's given us some great advice as we've grown the company. And there are a few other names who I've not mentioned who've really helped us a lot, but it's really been other entrepreneurs we've looked to.
And what do you do when you get conflicting advice? Does that ever happen? Do people give you different advice?
Happens all the time. And I feel like when we get advice, we always now we kind of know that we know our situation better than anyone else, at least like what's surrounding whatever problem we're asking advice about. And so typically we'll ask people for kind of their experience with similar issues to see what's kind of the same but what might be different in our situation. But we get conflicting advice all the time and kind of go back to try to take almost a first principles approach to what is unique to our situation that may or may not change given what the person who gave advice went through.
What kind of advice would you give to the next person that's getting ready to do a startup? Any kind of words of wisdom that you give them other than really think about not starting? It's hard.
Yeah, it's hard, and I'd say if you want to get started, the toughest thing is actually going and doing it. If you really want to do it, I think you can, but you got to understand that you're putting yourself in what's going to be a marathon and not a sprint. So, I feel like we're 5 years in, and to your point, Chris, we're far from where kind of our bigger goal is. And I don't know if we'll be there in another 5 years or if we'll ever really get there. But getting started is the toughest part, and kind of understanding the journey that you're going to take and having the right mentality that this is going to be a big commitment, I think is incredibly important.
And I know you guys have raised money recently, right? And you disclose or don't disclose, it's up to your discretion. But I think the question I'm asking is, there's this sense of, oh my gosh, I landed that couple $1 million, we're good. What kind of pressure does that add? Does it, or is everything we're going down to Destin and fishing, or what does that do? Give me.
Yeah, I'd say you definitely feel responsible for all of your stakeholders, especially as a founder. And I know that y'all, all of us here at the table, probably see this, where you're responsible for your employees, you're responsible for your investors, and you're responsible for yourself and your family as well, just really with what outcome you drive with the company. And so every time we have a new investor, I almost feel like somebody else who's new is getting added to that list of people who you're kind of fighting for. It's definitely motivating, puts a little bit of a fire under you, but you don't ever really feel good. At least in that sense. You don't feel like you don't have to do anything.
Yeah, I don't know. You guys have anything to add to that? Would you agree with that? Because I know all of you have done the similar. You
got to talk to.
You get the money in the bank, it should be easy sailing, right?
Yeah. Oh, I mean, that's really when the work starts, right? You get money, and the way you guys have it is a little bit different. You got to put some of that money to work, I guess. And there's an expectation on a return after a certain period of time for that money. But yeah, that's when the real work starts, is when you raise the money. I think sometimes people get super excited when they go out and raise money, or they get super excited when they've hired a team, or sometimes the first team member or some key team member, and you think, you sort of relax and think things are done, and then you get smacked in the face again and realize that you're just at the beginning. But I don't know about you, Sander.
Well, from my point of view, people always wonder about how much can you actually take on, right? But what's interesting for me is we're in the middle of our first raise, never having done this before. way less experience than you, or certainly if Scott. So, from my point of view, it's as we look at this, it's just going to be incrementally more responsibility. It's like you said, I feel that responsibility to myself, my family, and to now my employees. So it's just like bringing another family member in or one more person to be responsible to. Doesn't make it any easier, but maybe incrementally doesn't make it that much harder. I don't know. Maybe you could tell us.
Yeah, incrementally definitely doesn't make it that much harder. It's a little bit more motivating than anything, I'd say.
Yeah.
But it also becomes really helpful to basically build that community further. Where for us, winning additional investors, a lot of times that's come from our investors. And so having a bigger network for when you're looking to raise debt, looking to raise
Right.
equity
There's
is
more
really
you get
helpful.
from the intangibles that you get from the money that you raise and from those investors is what you're saying, right?
Yeah,
Yeah,
exactly.
that's cool.
So with each incremental investor, get a little bit more incremental benefit, incremental network, everything else on that.
Yeah.
end.
Yeah.
Well, listen, Jack, thank you for being our guest today. I every time I listen to you, I'm like, man, I could listen to this dude forever. Very interesting. And of course, Sander and Scott, thanks for being here today and helping educate our community on what's going on out there. So good luck to you guys, and go get them.
Yeah, thank you all so much for having me, and thanks for the great questions.
Thank you for joining us on this episode of the ATDC podcast. Please subscribe to our YouTube channel, like, and share or connect wherever you get your podcasts. Please be sure to follow us on social media. Our handle is @ATDC on X, LinkedIn, and Instagram.